Good morning, and welcome to a special edition of Squawk Box. We've got your ticket to Omaha and the Berkshire Hathaway Annual Shareholder Meeting. Our special guest for the next 3 hours, Chairman and CEO Warren Buffett. We'll cover Berkshire's biggest holdings, Buffett's latest bets, and his read on the economy. It's Monday, May 7th, 2018, and Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I don't know why that guy got to do the opening of the show. I could talk like that if I needed to. I'm Joe Kernan, along with Andrew Ross Sorkin. Becky Quick, City in Makeup again. She's live in Ahamo at the site of the Berkshire Hathaway annual meeting. I saw it again. And she joins us now with a special guest.
Yeah, who's that?
Warren Buffett. Warren Buffett in Omaha.
Buffett,
Becky.
see? You can't do it. That's why we have Jim Birdsall. You can't do that voice.
Who needs
Becky?
I don't know what we pay him.
Good morning, guys. It's great to see both of you. And I am in Omaha, Nebraska this morning. That's the site of the Berkshire Hathaway annual meeting. Our special guest for the next 3 hours, if you haven't figured it out already, is Berkshire's chairman and CEO, Warren Buffett. And Warren, thank you so much for being here this morning.
Thanks for having me.
You are coming off the 53rd annual shareholders meeting. And it's something that we've been coming to you for years, but 53 years in on this. I just want to ask you what you thought about this weekend, how you feel about all of it. What stood out to you through this weekend?
Well, I think everybody had as much fun as ever. I mean, we had a crowd that certainly equaled our record, and again, I run into thousands of shareholders, and they're all having a good time here, and our directors have a good time. So it's just sort of a Mardi Gras.
Was there anything different about this meeting, or is it the sameness that makes it so special?
It's the sameness, pretty much. I mean, working with Charlie Munger, we're not going to change the format very much.
Although Brian pointed out earlier that there were a lot of kind of controversial subjects, a lot of things that caught people's attention and picked up a lot of news this time, and it's because you and Charlie say what you think, especially Charlie.
yeah, Charlie says exactly what he thinks, and he thinks in colorful language, too, have you noticed that?
I've noticed that. Has that changed over the years, or is that just more the same?
That's Charlie.
Yeah, that's Charlie, and since you met him?
Since 1959, when I met him.
Okay. Warren, let's talk about some of the things that really resonated with people, and maybe start where you began the annual meeting this year, and that was talking to your investors and telling them a little bit about investing, some tips and lessons along the way. You kind of used it as a teaching experience at the top.
Yeah, normally I don't do that. I mean, in fact, I can't remember when I did it. We just go right into questions and answers, but I really thought that maybe we were giving a little bit the wrong lesson, because all the questions would naturally tend toward current events. And so this time I went back actually to 1942, when I bought my first stock, as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war, and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
You went back to that day in 1942 because it was the day you purchased your first stock. We should point out you were 11 years old then.
Right.
So
yeah, and And the day I bought, I mean, the headlines.
The other side.
Yeah, the headlines were terrible every day. You know, within 2 months of this.
This is the New York Times from 1942 that day.
Yeah, the 1942 New York Times sold for 3 cents, and I also got the headlines from some days before, and everything was going badly. The Philippines were going to fall within 2 months. Things were grim in Europe. Our ships were being sunk, and the war was bad then. And that day that I bought, March 11th, the Dow Jones cracked 100 on the downside. There was a 2% decline, which would be 500 points today. And the night before, on March 10th, I said to my dad, I want to go all in. I had $125, and I put every bit of it in 3 shares of City Service Preferred, and which is still my personality, is to shove it all in.
As we've seen with Apple.
Yeah, somewhat. And as I pointed out to the crowd, I bought that stock at 38.25. It was down from 84 the year before, and it was down from 55 in January. And I thought, I'm really buying it cheap. So it went down to 27 after I bought it. And then I did it, and it went up to 200 later on, but I sold at 40.
You know, these are lessons that you point out because you tell investors that they shouldn't really be trying to market time. They shouldn't be looking at things. You should invest, stop paying attention, and look away. But you are somebody who does pay attention to market valuations, buys more if you think a stock is cheap and less if you think it's expensive. And I'm just wondering where you think the markets stand right now. When we talked to you back in February, at the end of February, you said you thought things were not overly priced, but you didn't find any businesses that you yourself felt like you could purchase. Where do you think things stand right now?
Yeah, and we haven't bought any businesses in their entirety since I saw you last. We bought a lot of Apple, as we pointed out the other day. If I had a choice between buying the S&P index or buying the 10-year U.S. Treasury or the 30 U.S. Treasury, it wouldn't take me a nanosecond to go into stocks. Now, that it may be because bonds are going to fall a lot, but the investor has a choice between 3 or 4 things. They've got stocks, they've got short-term governments, they've got long-term bonds or long-term governments, or they could buy a farm, a small farm, or
what about corporate bonds too?
Yeah, they can buy corporate bonds, but they probably don't know enough to evaluate credits. I mean, they will get enticed into junk bonds at exactly the wrong time. That's when the issuances will come, and the covenants will be non-existent. And so
you're talking about average investors who don't do this for their day jobs.
Not professional investors, right. but average investors. But 99% of people are non-professional investors, and that would, if they had to do that to come out decently, you can understand I'm sort of gambling on that. But the point is, you don't need to do it. You don't have to buy exactly the right stock or buy it exactly the right time. The one thing you have to avoid is buying the single wrong stock or at the single wrong time. And most people get excited about a stock or about the market after it's gone up. I mean, their neighbors made a lot of money, and they know they're smarter than their neighbor. It's very irritating to have a neighbor buy a new car, and your spouse says, is that guy smarter than you are, or what? So they have this, they're enticed into the market at the wrong time. And all they really need to do is buy a cross-section of America, and it's best to buy it over time. If the first 10 years of your working life, you just save and invest for that period of time, you don't have to be the right time.
You made the point even more drastically over the weekend in terms of looking at treasuries, U.S. treasuries, basically said there's never been a good time to buy it, even going all the way back to the war bonds back in the 40s.
Yeah, that is true. Now, you bought them for patriotic reasons, but the government then was offering you 2.9%. You bought a U.S. You call them a war bond, then they called them defense bonds, and then savings bonds later on. But we were happy to buy war bonds then, and we paid $18.75, and we got $25 in 10 years. For 3 gets you 4. That was, in fact, they took "Take Me Out to the Ball Game" and turned it into a song about buying war bonds, you know. And for each 3, you get 4 at the old bond game. And there's literally a song, and we'd sing it at school. And the government happily pointed out to you that you were getting 2.9% compounded for that. And of course, now you have a situation, the Federal Reserve says they want inflation of 2%. So they say they're going to try and devalue that bond by 2% a year in the dollar terms. And it's almost always equities have been a better buy. And certainly if you're going to put away money over time when you're younger, if you buy stocks over a considerable period of time, you're not going to get the lows, but you're not going to just buy at the highs. And if you buy a cross-section, well, like I say, it'd have turned $10,000 into $51 million, and you'd never have had to look at a financial page again or listen to a broker.
Going back to this idea, though, that the markets, you think, are a good place for average investors right now. The S&P 500 is a good place. If you're a professional investor, if you're somebody like you look at prices and you think what? Well,
I look at prices and I find it hard to buy things. And incidentally, professional investors aren't going to do better than the amateur in almost all cases. But I don't find things easily. I mean, we were on in March of 2009 when the Dow was in the 660s or 670s, and we talked about it then. I mean, it was the bargain counter, and it continued for a long time. Stocks have been very, very cheap, but you have to measure them against alternatives. I mean, if government bonds got to 15% like they were in 1982, that's a different equation against stocks than exists now.
You've had periods in the past, though, where you have said stocks look expensive to you, or that we look like we're in bubble-type territory. This is not one of those times, I take it?
This is not one of those times. Now, if government bonds go to 7 or 8%, which means if you own a long bond now, you get killed, the stock you bought now will not necessarily look attractive. It probably won't be attractive. I mean, interest rates are like gravity. If interest rates are 1%, and they're going to be that for 100 years, obviously anything that yields you 2 or 3% is going to do way better. But I don't think they're going to be 1% for 100 years.
Just to get into the nuances again, though,
yeah.
You're talking broadly about issues in terms of how you see the stock market as a great place for average investors, maybe a place where you're not finding all that many bargains. And when you look to buy a company all in, I mean, I've spoken with some people here this weekend who know an awful lot about M&A, who know a lot about private businesses, what they're valued at different things, who say that when they're looking at prices, things look really rich. You're talking about prices that are 15 to 20% above what's a fair price as they see it. Is that match up with what you see right now?
I would agree with that. That's why we haven't bought any businesses for quite a while. In addition to the normal factors in the public market, when people buy businesses these days, frequently they're being bought by people that are borrowing 60 or 70% of the money, maybe even more.
You're talking about private equity?
Mostly private equity, but not exclusively private equity. And we're not willing to calculate our returns based on borrowing money at 70% of the purchase price. That may be the best thing to do, but we calculate things generally on an all-equity basis, and we are not competitive. And then you've got a general euphoria that, to some degree, the private equity funds have to put the money out, and it's kind of interesting what they do because they take the money which they get usually from institutional investors, and then they buy a company in the market from some of those same institutional investors, except pay a premium, and they say we can run it better if it's private. Then they hold it for a while, and then they sell it back to the market, and these private institutional investors, having paid substantial fees during the meantime, and say it's better to be public. I mean, it's an interesting exercise.
Let's talk about some of the things that came up this weekend that really caught people's attention, some of the more controversial statements that came out. At one point this weekend, you said that Bitcoin, and this was based, you were asked, Charlie said Bitcoin's like rat poison. You were asked about that comment, and you said, well, it's probably more like rat poison squared. Charlie went on in the meeting to then basically call Bitcoin turds.
He is an expressive sort, isn't he? Maybe when he gets a little older, he'll mature.
I just want to ask you about that because it sparks so much controversy, and particularly on Twitter and some of the places where you might expect people who are trading in cryptocurrency to be pretty loud about what they heard. What is it about Bitcoin that gets you guys so fired up?
Well, when you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. I mean, you look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing. One of the interesting things, for example, is gold. If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe 1/10 or 2/10 of 1%. You know, and then you have to insure it during that time and make sure somebody doesn't steal it from you and everything. But it doesn't produce anything. And productive assets, you can pay too much for a productive asset. But I bought a farm in the 1980s, and every year look at how much it produced the way of soybeans and corn. And at the end of that period, I've still got the farm, and I've gotten some significant income off of it. Apartment house, operating business. But if you and I buy various cryptocurrencies, they're not going to multiply. They're not going to be a bunch of rabbits sitting there in front of us. They're just going to sit there. And I got to hope next time you get more excited after I bought it from you, and then maybe I'll get more excited and buy it from you. And actually, we could sit in a house by ourselves, and we could keep running up the price between the two of us. But at the end of the time, there's one Bitcoin sitting there. And now we got to find somebody else, and they come to an end. I mean, those.
So, I mean, that's a greater fool theory. That's what you're saying.
Well, yeah, it's buying something because you expect the pool of people who want to buy it because they want to sell it to somebody else will grow, and it's wonderful because it does create a rising price. Does create more buyers, and people think I've got to get in on this, and it's better if they don't understand it. That's the other thing about non-productive. If you don't understand it, you get much more excited than if you understand it. I mean, if you buy a bond that says it's going to pay you 4% a year, you're not going to get any pleasant surprises. She's going to pay you 4% a year. But if you can have anything you want to imagine. If you just look at something and say that's magic, you can do it with shark's teeth or seashells or anything. And they did it with tulips in the 17th century in Amsterdam, and they'll do it again. I mean, people, they like to speculate, they like to gamble, and if you can get something, particularly if you have something half plausible going on, if you had bought gold in 1942 and you say, we might lose the war and we might have to run off to some other country, and so let's put our assets in gold, you would have less than a penny for every dollar you got from owning stocks. Less than a penny. Now, if somebody calls that a store of value, I mean, I think they're delusionary.
Okay. Andrew has a question, too. Andrew.
Hey, Warren, related to this issue of Bitcoin, you saw that Goldman Sachs just last week announced that they were going to create effectively a trading operation around cryptocurrencies and Bitcoin in particular. You've been an investor in Goldman. What do you think of their decision to do that?
Well, they probably think that lots of people are going to get very excited about it. Well, and maybe already are, but they think there's money to be made trading them. I don't think they're expressing an opinion on the ultimate value. I would be very surprised if the top partners of Goldman are selling their Goldman stock and putting it into Bitcoin. But I want to cover this subject now because my friend Charlie will come on at 8 o'clock and he'll tell you what he will say.
Well, that's my whole entire point. I do want to ask Charlie about it because I think when he talked about the turds, he was referring to this. He said if you're trading this, it's like watching other people trading turds and deciding you want to get a piece of that.
Well, you're not going to get me to comment on that.
Hopefully Charlie's not awake and not watching right now.
Well, the truth is people do trade on very crazy things over time. Imagine people selling their homes to buy a tulip in Amsterdam. If people think they're going to make money the next day And worse yet, if they think somebody else that they know is going to make money and they aren't going to make money, it just draws people in. You know, I could whisper something on this program, and kind of the more sillier it was, the more it might react, because there's no quantitative limits. If you buy a stock, you say, well, I'll buy it at 15 times earnings, but I won't buy it at 20 times earnings. But when you get into something that doesn't produce anything, you know, there's no checkpoints. There's nothing to reference it to. It's just, it's gone up, so it'll keep going.
Now, I will say, when I was tweeting the things that you and Charlie were saying about this weekend, all I was doing was repeating what you were saying, and people were coming back with some pretty angry comments, including things like, I bought a house buying cryptocurrency. You're outdated on this. They said a lot meaner things, that you don't understand it, so you should shut up about it. What? You're not.
Well, the interesting thing is, if you're investing, you don't worry what other people say. If I'm investing in Apple, I love the idea of people saying Apple is terrible, because I want the stock to go down, because they're repurchasing shares and my interest will go up faster. You don't get defensive if you're buying something that produces that. You don't buy a farm and get real defensive if somebody comes along and says you shouldn't buy a farm or something. You say, look, once the crops grow and I can see what I'm selling my crop for at the end, and I'm making 4% or 8% on my investment. You get defensive when you look at this thing and it doesn't do anything. You're just hoping somebody comes along to pay you more tomorrow or the next day, and you're dependent on more people, the mob growing, you know, basically. So those people do get angry. But the person that bought a house with it, I would say they did the very right thing. They sold it.
They sold it and bought something else with it. Hey, Joe, you have a comment too?
I was thinking it, but look how long it took you to buy Apple, though, Warren. I mean, you finally did buy it, but you needed to be, you know, it just took a long time. I don't know what happens with Bitcoin, but you see, I don't understand it either, but it's got quite a following among all these people that, you know, think it's going to 25,000 or 100,000. I mean, it did take you, you've never embraced technology as much as a lot of other things that you understood a lot better. And you're finally in Apple, but what did you finally buy Apple? It's already, it was probably a $700 billion company when you finally bought it. You could have, you know, it would have been nice to buy it at 100 billion or 50 billion.
Yeah, and I say about buying apples, I don't care whether anybody ever mentions Apple again. I mean, you know, whereas with Bitcoin, people that buy it want to tout it, because they want more people to join the crowd. So they want to come on and say, you buy Bitcoin, because they're going to lose money unless the crowd gathers, if the crowd starts dispersing. So they've got every reason in the world to tout it. When I buy Apple, I know that Apple is going to repurchase a lot of shares. So right now, Apple had whatever it did at the quarter, 4,927,000,000 shares, or 923 million, whatever it was. And we own about 5%, but I know I don't have to do a thing. Yeah. And probably in a couple of years, we'll own 6% without laying out another dollar. Well, I love the idea of having 5% go to 6%, and the cheaper the stock is, the more they will get for their money when they're buying it in. So there's just no reason at all for me to encourage other people to buy Apple.
What was that? You know, I hadn't heard anyone say city service in a long time. Was that? It was it was a preferred stock. It must have been convertible, wasn't it, or something, to have huge price swings?
No, what happened, Joe, was that City Service started out as a utility company, kind of like it sounds, way back around 1910, sometime around then.
Right.
But then they started developing natural gas, and then they found oil in connection with it. So over a period of time, it still was a big utility company. It morphed into a basic energy company, production company. But they issued, when they were a utility primarily, they issued a $6 preferred, that cumulative preferred, and it quit paying dividends in 1932. Like a lot of people, they ran out of money then. So from 1932 forward, you had this preferred, which $100 par, which was accumulating at $6 arrearages. The year before I bought it, they actually made a $3 payment on arrearage, but that still was less than a $6 coupon. And then they eventually called it at 200 and something, which was $100 par, probably a call premium, plus all the arrearages. It was not convertible.
I see. That's pretty amazing, though. You were 11 years old when you... And what a history City Service had. I mean, there's a Boone Pickens and a Pac-Man defense. It was bought by Oxy. And then part of their gas stations were bought by Venezuela, remember? And they were giving free gas around. And the Red Sox,
sure.
The big Citgo sign up at... near the baseball stadium. So it's amazing.
Right.
Yeah.
Right. No, it became a major oil company.
Yeah.
They actually, I think, sold the preferred door-to-door way back in the 20s or sometime like that too. But
quit talking about buying the farm. Every time you say bought the farm, I'm like, what's it? I'm like not listening for a second. And then you go, I'm buying the farm. It's like, stop talking about that. I looked up what. That's a weird expression that came from. It's very morbid what it actually came from, but. I'm not even going into it, but there's a derivation for where it came from when I guess if guys they want to come back from a war and they're going to buy a farm when they do, and unfortunately it's their family that ends up buying it from insurance proceeds or something. It's horrible. But anyway, yeah, let's move on to Bitcoin and
to different
Apple.
assets on this.
In the World War II, there was. Go ahead. I'm sorry.
Go ahead.
It was very interesting in one sense because John Maynard Keynes had written in 1935 or 1936 the general theory, and Keynesian economics around my household, everybody thought it was a total fraud and all of that. The World War II forced the country into this huge Keynesian type financing. I mean, we had the deficit finance in a way that was incredible, and the debt went up to 120% of GDP, which is considerably higher than it is now from a figure far lower than that. And we sent millions of the most productive people. We took them out of the economy. We started building things that we dumped into the sea. We did it on borrowed money, and it created the runway for the greatest economic progress the world's ever seen.
Wow.
Warren, let me ask you one more question. Oh, go ahead.
No, so that almost. So is that like an endorsement of Keynesian economics, Warren?
It certainly worked in World War II. I mean, I do not think the 40s and 50s and 60s would have developed remotely like they did without the huge deficit spending and all these events that we were struggling to get out of the 30s, and then they just turned the spigot loose, which they had to do, and build a whole bunch of things they dumped in the sea. They weren't building refrigerators or cars or anything like that. There were a lot of people that predicted one of the things that I do remember very well was that a lot of very respected figures said we would come out and have a depression post-World War II, just like we had post-World War I. So that was a prevailing sort of.
But are there times to be Keynesian and then times to pull it back in and rein it back in?
Yeah, well, but Keynes would say that too. Yeah.
Well, we need a guy with a little experience to talk about all this. Not someone your age. We need Charlie on, who can probably really.
Charlie.
Yeah.
Yeah, right.
With a little experience under that belt.
Give him, be prepared to bleep him out, though.
We need a 3-second delay with Charlie. Hey, Warren, let me ask you, just city services. You've talked about this. I knew that was your first purchase. I knew you were 11. But for people watching at home, you hear an 11-year-old picks out a stock and asks their dad to buy it, particularly when their father is a stockbroker. You assume their father is the one that led them to that conclusion. My guess is you did that all by yourself. How did you come up with it?
I must have heard somebody talk about it. But then if you looked at city service at that point, here was this company in the Depression, didn't have the money to pay it. Now all of a sudden it was paying down its debts, and it was going to earn a lot of money. And they had a lot of, they had assets that were becoming worth more. And we were going to have inflation after World War II, so that assets probably were going to be worth more while their debt was coming down. And the earnings on the preferred were terrific. They just weren't paying them out. So I was going to get $200 at some time, but the problem was that buying it at 38 1/4, as a matter of fact, and having it go down to 27, and walking to school with my sister, who also wanted to buy 3 shares because I was buying it. She hated to see me get rich while she wasn't getting rich. And having her point out that this thing was going down every day. When I got back up to 40, and we each had a chance to make a $5 profit. I thought, you know, now my sister will again consider me a genius, and I will have $5 more. How can life be any better? So then I watched it go to 200 after selling it to 40.
Lessons learned early in life, probably very powerful ones. Warren Buffett's going to be with us until 9 a.m. We have a lot to talk about still, but guys, I'll send it back to you in the studio right now.
Okay, thank you, Becky. Coming up when we return, we have two special guests joining Becky and Warren Buffett. That's going to happen in the 8 o'clock hour. Berkshire Vice Chair Charlie Munger, we are getting the 3-second delay ready for him. And then Berkshire board member Bill Gates. Stick around, we got a lot more coming back from Omaha in just a moment, right here on Squawk. Good morning. Welcome back to Squawk Box right here on CNBC. Let's show you U.S. equity futures at this hour. Let's let you know what's going on right now. Dow looks like it would open up higher, about 16, almost 70 points higher now. NASDAQ looking to open about 38 points higher, and the S&P 500 looking to open up about 9 points higher. Quick look at crude right now. Barrel cost WTI $70.42. That's the highest level since November of 2014.
It makes you wonder when, if the Iran deal is decertified, is it in the stock or is it in the price already? Right. Because that's it's not going down if the president decides to exit that deal. Let's get back to Becky out in Omaha with our special guest, Mr. Buffett. Beck.
Joe, thank you. Once again, we are in Omaha with Berkshire's chairman and CEO, Warren Buffett. He's going to be with us through the entire morning. We'll be joined also by Charlie Munger and Bill Gates a little later in the program. But right now, Warren, let's talk through some of the individual stocks that you've spoken about this weekend. Maybe the most controversial one was Wells Fargo. You were questioned directly on that at the shareholders meeting with questions from shareholders and who have said, okay, and I did hear this from other shareholders later on, Wells Fargo has run into trouble time and time again. The fines have continued. The developments and things that we found out about some of the cockroaches, particularly, you know, as you might phrase, continue to come out. But you've stuck with this stock and said that you're not selling and that you have faith in Tim Sloan, who's the existing CEO. People have pushed back and said, look, this is a company that's run into trouble and it doesn't jibe with what we've heard you say about Solomon. How do you say, yes, this does fit with our investing philosophy?
Well, at Wells Fargo, they made one mistake that maybe I've made from time to time, which is incentives work, and they came up with improper incentives, and they worked, and so they incented bad behavior instead of incenting good behavior, and that happens from time to time. You can put too big a commission in something or the sort.
But let's talk very specifically about what incentives were created. They were incentives that rewarded people for the number of new accounts that were opened. They regularly on their investor presentations would say we've got so many, and 8 would be great, and 6.2 was better than 6.1 products. So they put this huge emphasis to the public out there, as well as to the employees, but to the public, that they had more services per to their shareholders,
as shareholders, and everybody listened. And surprise, surprise, people started creating fake accounts, and when bad behavior gets in there, other people figure it out. I mean, if you get rewarded for bad behavior, you're going to have a lot of bad behavior. That's a problem. I'm sure it's a problem we've had from time to time in Berkshire and other places. But the real problem was, when you find out about it, you've got to stop it immediately. I don't know the details about why it wasn't stopped, but I've seen that before. And then it just gets out of hand. And if you don't stop it immediately, then if you do it 4 months later, everybody will come and say, well, why didn't you do something 4 months earlier?
But let's be a little more pointed with this. This was not just a case where Wells Fargo was not stopping bad incentives immediately. It was quashing whistleblowers who were behaving properly and firing them.
I don't know the details too much on that, but
from what's been reported, I don't know this firsthand. I don't know this firsthand, but from what's been reported, there have been many whistleblowers who said that they were trying to do the right thing. They tried to report it, and as a result, they wound up losing their jobs.
Once you have not done it, you're in the soup. Yeah. I mean, John Goodfriend in April of 1991 got word that Paul Moser, a trader in government bonds, was doing something that was very wrong, and he absolutely, John was not profiting by it, he didn't know about it, but the next minute he had to pick up that phone and call Jerry Corrigan at the Federal Reserve of New York, and everybody thought he was going to do it in the room, but it was unpleasant or he got distracted. And then on May 15th, Moser did it all over again, and now the position you're in is you call up, and you knew that this pyromaniac was out there who would set fires, and you let him ride another match, and then you're in big trouble. Anyway, you have to act. I mean, Charlie's been very good with me on things like that. If I tell him about anything that's a problem, I mean, he doesn't let me procrastinate. And I might procrastinate otherwise. It's a very human trait. But anyway, and then they uncover other wrong things as you get into it. Now, a couple of our great opportunities came from similar situations. I mean, Geico had a CEO in the early 70s who refused to accept the fact that the loss reserves were developing badly. Now, if you refuse to accurately assess your loss reserves, you also don't know your costs because you sell the product first, and then you start kidding yourself on the costs. And then you get in a hole, and now your reserves are, and maybe you figure it out, but then you've got to admit it if you do it, and it's just easier to shut your eyes and hope that something good happens. And it essentially bankrupted the company. Now, that was a huge opportunity for us because Geico was a solid company underneath, but their balance sheet was a mess. They needed to raise capital. They almost got their licenses withdrawn, and we bought half the company for less than $50 million. So the fundamental business that Wells Fargo, they've still got the accounts. They've got the loan customers. We do business with them every day. And incidentally, other banks ran into many other kinds of trouble in the 2008-9 period, more on the selling bigger stuff, maybe mortgage-backed securities or something of the sort. So the banks had their share of trouble, but Wells had theirs in a particularly egregious way, which was really kind of thumbing their nose at the public. They made way, way, way less money doing that than if they were bundling big MBSs and raking it in by the tens or hundreds of millions. And the fines were big, even bigger. But going forward, you can stop bad practices. They should be stopped earlier, and they're much easier stopped. I
look at the situation with Solomon, and you came in and were the person who had to clean it up. Tim Sloan was an insider. Tim Sloan was not the one who, this didn't happen on his watch, but he was an insider. Can you be an insider and still be the one who cleans it up?
Well, I cleaned up affairs with Congress and tried to set a tone and everything. Derek Maughan came in, and I put him in total charge of running Solomon Brothers, and everything he did, that was perfect. I mean, and he had all kinds of things he had to look at. We didn't know when we'd get more of us surprises, and he was working 15-hour days. He never asked for any extra compensation of any kind.
And he was an insider at Solomon.
And he was, oh yeah, he'd been an insider there, sure. He was one of 7 or 8 people that were top people I interviewed. I had to have an insider because I arrived there on a Friday, and they were about closing us up. And somebody had to run a business that was doing maybe hundreds of billions of dollars worth of business and things like government bonds and everything. And we had the largest balance sheet in Wall Street. So there was no way I could wait and get an outsider. I interviewed people on a Saturday. I started interviewing at 9 in the morning. I got in on a Friday. And I had to come up with somebody by Saturday afternoon to run the place. And there were people in that room that had semi-contributed to the culture anyway that had led to this activity. And so I picked an insider who knew about it, knew all the people involved, and the guy behaved magnificently and got me out of trouble.
Joe?
Andrew wants to talk to you.
The same thing happened to Geico. They picked... Yeah. They picked a new guy. They picked Jack Burnham.
Warren, I wonder how much Wells Fargo talks to you. they're on a complete reset now. Yesterday was the Wells Fargo championship down at Quail Hollow. I don't know if you saw it, but the entire advertising campaign, they go back and show when Wells Fargo was founded, and they show stagecoaches and everything they did, and then they just go to a complete blank where they say, but this happened, and now it's the new. I mean, they paid someone to get an entire ad campaign that there's been a complete reset and we're starting over, and the spokesperson that they had on at the tournament, it's all they talked about as well. I mean, that took a while, but they finally got to the point where they're saying all that history is in the past and we're starting all over right now, which is pretty amazing that they had to come to that point. Did they talk to you about that advertising campaign? I guess they did.
No, no.
No, they didn't. But
no, we never. And at Sullivan, we did not run an advertising campaign, but I ran a 2-page double truck ad in the New York Times, the Wall Street Journal, and the Financial Times when we reported our third quarter. And I said what was wrong, and I said how we were going to change it, and it was in very small type, and we needed change. Wells, it's interesting. I first bought in when Carl Reichert was running, and I can tell you that there's no finer guy than Carl Reichert. It wouldn't have happened under Carl Reichert, but institutions make mistakes, and I will tell you this: we have 377,000 people working for Berkshire, and right now, I don't know whether 5 of them or 10 of them or 20 of them, but I'll guarantee it isn't 0 of them, are doing something wrong. And my job is to act when I hear about anything, and to make sure we've got some system so we do hear about things. So we get about 2,000 contacts through what we call the hotline a year. I get anonymous letters, and those are the 2 best sources of finding out where something's wrong. I mean, it's better than having 100 people crawling all over the books. Anonymous. Oh, they're not. Sometimes they sign them, but I received one last week, and
You received one last week about something happening at Berkshire?
Yeah, sure. But I mean, I received them all. I mean, they're going to come in, and sometimes people just don't like the person working next to them, so they come in for a lot of frivolous reasons. But you have to look into what it is, and if you look at 100 and 99, or the guy next to me has bad breath, or something like that. But that's the way you do find them. Overwhelmingly, is tips, basically.
How do you track down every one of those tips? Well,
we have an audit department that sorts out the ones that they think that I ought to see. I mean, so Becky Amick is in charge of the audit department, and incidentally, the larger companies, they have their own groups too. But those people can not only write their own company, but they can write us. And some of them just come into, a letter comes into Warren Buffett, chairman. It's usually not signed, but that's okay. I mean, and obviously when they get very specific and say this is going on or that's going on, that's what happened with American Express in 1964. They had a field warehousing subsidiary. They were getting calls from a guy at a bar in Bayonne to the head of and he was saying the tanks are phony. Go to this tank and go to that tank, and you will find that it's not filled with salad oil. And the guy didn't want to hear it, and he didn't want to tell his boss, and it just gets worse and worse and worse.
Hey Warren, after you had commented on Wells Fargo during the meeting when we discussed it on Saturday, I got a couple of emails of folks who asked me if there could be a follow-up question. So the follow-up question is this: when you bought Solomon, you came in after Solomon had its problems, and some of the other examples that you gave, the opportunity came because you weren't in the stock. In the case of Wells Fargo, you've been in the stock. So there were 2 questions. One is, do you wish you weren't in the stock when they had the problems? Meaning, would you prefer to put your money, for example, in something like JP Morgan, which I know you've put personal money in before? And somebody else said that, you famously said, if you lose reputation, I will be ruthless. And the question is, when will you be ruthless, or at what point would you be ruthless, either in this case of Wells Fargo, or does it have to be even more egregious?
Well, I'd be ruthless anyway. He's working for me, but I don't. The answer is, of course, I wish I'd bought the other stocks, bank stocks, and then sold them now, so I'd be buying Wells Fargo now. I mean, Wells Fargo actually is buying in a lot of shares, and you can argue that they're improving the per share value because they had this bad news. They're buying it cheaper. But I think 10 years from now, I think if you look at the 10-year record of Wells Fargo 10 years from now, you're very likely to find that it outperforms most of its competitors.
Would you be buying more shares now if you could? You can't because of the bank thresholds.
I don't want to give recommendations on which stocks to buy.
To Andrew's other point, though, I think you touched on it very quickly, but the idea of being ruthless, if you lose a shred of reputation for the company.
That's Berkshire.
Right, but what you're saying, you're distinguishing between Berkshire-owned companies and investments.
Sure, sure.
It may be worth pointing out that you're a passive investor in Wells Fargo and the bank, and you have to be.
Yeah, well, I have to be a passive investor.
But I'm not sure everyone understands that.
We do not want to be a bank holding company. We can become a bank holding company if we own over 10%, and then there's a point at which your activities could make you or something. So we owned a bank, and we had to dispose of it back in 1980. We bought a bank, and then they passed the Banking Act of 1969. We'd have bought more banks, actually. I like the banking business. And then they changed the law in 1969, and we had 10 years to divest. Maybe they changed it in 1970. We had 10 years to divest of the bank we owned. But I would not. We'd still own that bank, and we'd own other banks if they hadn't changed the law in the 1970 period.
Okay.
But I don't feel responsible. If you're having trouble with your Apple phone, don't blame me.
Okay, we have much more from Warren Buffett still to come. Right now, we're going to send it back to Joe and Andrew in the studio.
Okay, coming up when we return, Billionaire Summit, Warren Buffett's going to be joined by Berkshire Vice Chair Charlie Munger and Berkshire Board Member Bill Gates. That starts at 8 a.m. Eastern Time. Squawk Box returns from Omaha in just a moment.
However, actual trains are going a little faster than this, actually.
Are you having fun?
I'm having fun.
Yeah?
I love doing this. I do this every morning.
All right, good morning again, everybody. Welcome back to Squawk Box, where we are live from Omaha. Today, we are introducing the Warren Buffett Archive. This is a website with the world's largest collection of Buffett speaking about business, investing, money, and life. It includes 25 full annual meetings for Berkshire Hathaway with Warren Buffett and Charlie Munger taking questions from the audience. It goes all the way back to 1994 with a highlight reel for each year. By the way, folks, this is the only place that you can get this complete archives. It's also got 130 hours of searchable video. It's synchronized to 2,600 pages of transcripts that have been painstakingly checked by Alex Crippen, who did a phenomenal job of running through and making sure he knew exactly what everything that was mentioned was done. This was done by hand. I'm calling it, instead of AI, AC for Alex Crippen. There are 500 video clips covering scores of subjects, plus CNBC interviews, a Buffett timeline, and a Berkshire portfolio tracker. If you want to check it out, make sure you do it today. It's buffett.cnbc.com. Warren, you got a chance to take a look at this, too. And this came from you giving Steve Burke, our chairman at NBC Universal, access to 25 years of annual meetings. This is stuff that only Berkshire's been holding on to for this time.
Yeah, Steve had suggested it to me a few times, and then he suggested it a little stronger. and it sounded like a good idea. I didn't think it could be done like this. So we just gave him all the annual meeting material. We didn't give the movie because that's got some stuff that we promised not to put out.
You mean with celebrities who have done
the celebrities
things.
Come on, yeah. But in terms of the annual meeting stuff, door to, portal to portal, and everything we had, and even with university students or anything we had, we gave Steve. And I told Steve, you can do with it exactly what you want. I mean, I've known Steve a long time, and I thought it'd be an impossible job, but I knew that if it was done, it would be done well. And it blew my mind when I saw it.
I mean, it's been really useful for me just going back trying to figure things out, because over the years things kind of blend together when you said what, or exactly what you said, or if it was you who said it or Charlie who said it. The search function is better than I had anticipated, just in terms of being able to look up things. Like maybe I wanted to find out when you started buying shares of Apple. Type in Apple shares and it comes up. And I can even go back, link to the transcript, and then click to the video of you saying exactly why you were buying it.
Yeah, it'd be more fun for me to just recall what I was saying at the bottom and all that sort of thing. But it's all there. I mean, and that's the way it should be. I just love the idea.
Great, thank you. And folks at home, if you are wanting to check this out, the address again is buffett.cnbc.com. The website is live. We'd love to hear what you think about it, too. When we come back this morning, we have much more from Warren Buffett. Plus, we'll be joined for an hour by Berkshire's Vice Chair Charlie Munger and Microsoft co-founder and Berkshire board member Bill Gates. That is coming up at 8 a.m. Eastern Time. We will be right back, live from Omaha, Nebraska.
Good morning, and welcome to a special edition of Squawk Box. We've got your ticket to Omaha and the Berkshire Hathaway Annual Shareholder Meeting. Our special guest, Chairman and CEO Warren Buffett, will cover Berkshire's biggest holdings, Buffett's latest bets, and his read on the economy. It's Monday, May 7th, 2018, and Squawk Box begins right now.
Good morning. Welcome back to Squawk Box right here on CNBC. I'm live, or we're live, I should say, at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin and Joe Kernan. We are here. I'm back from Omaha. Becky is in Omaha this morning speaking with the one and only Warren Buffett. And we're going to get back to them in just a couple of minutes. In the meantime, let's just show you U.S. equity futures at this hour for a quick second. We're going to show you right now that the Dow is looking up. Dow up about 90 points. NASDAQ up about 43 points. And the S&P 500 up about 10 points. Also want to show you some headlines this morning. A couple biggies. Nestle striking a $7.2 billion deal with Starbucks to sell packaged goods globally. Now, Starbucks says it's going to use the proceeds to speed up share buybacks. Also, Tesla says it's evaluating capital expenditure needs. And in a new SEC filing this morning, Elon Musk's company adds it may raise additional capital to fund the growth of its business. We're watching energy prices as well this morning because WTI crude topping $70 a barrel for the first time since 2014. And the Lumberg survey finding gasoline prices are also rising, a 10th straight week of increases, bringing the average price of regular grade gasoline to $2.90 a gallon. In the meantime, I want to get back to Becky in Omaha, speaking with Mr. Buffett. Becky.
Andrew, thank you very much. Again, folks, we are live in Omaha, Nebraska. This was the site of the Berkshire Hathaway annual meeting this weekend, the 53rd annual meeting. Our special guest is Berkshire's chairman and CEO, Warren Buffett. And Warren, thank you again for being with us this morning.
It's fun.
It is fun. I want to talk through the cash hoard that Berkshire has. At the end of the year, you had $116 billion in cash. You told us last week that you had spent about $12 to $13 billion in the first quarter, so you were thinking the cash hoard was closer to $100 billion based on some other things that you had potentially bought as well. Okay, so you're spending billions of dollars, but you still have $100 billion. Is that ideal?
No. We earn very little on it, but that is, we will earn a little more this year than but it's just about the world's worst investment, except doing something dumb that you're doing for a longer term. And but it does give you the ability to move very quickly if something very big comes along. But I would much rather have that number be 30 billion than 100 billion, and have that the other 70 billion invested in, ideally, in businesses we own, but also in securities we own. And we did, for example, put out, I don't know whether it was 12, how much was in the first quarter and how much was in April, I'm not sure. But we put out 15 or so billion net into stocks, and I like that. And it wouldn't, if I could find them and buy them in sufficient quantity, if that had been 50 billion, I'd have been even happier in the first quarter, or if we'd bought a $50 billion business. But you don't want to let money burn a hole in your pockets either. I mean, if we buy a business, we buy it to keep. So if we pay X for a business or 2X for a business, the business doesn't know. It doesn't adapt itself to what I pay. It's going to earn the same. And so if I make a mistake on purchase price, Berkshire Hathaway lives with that mistake forever.
For the rest of us who see you sitting on $100 billion, we think that you think the market looks expensive and that you can't find anything that's worth putting your money into that makes it better than cash or short-term treasuries.
We own $170 billion worth of equities. We go up every quarter, and we went up a fair amount in the first quarter. No, I would rather own the $170 billion of stocks we have than own treasury bills by a very significant margin. But there are limits to how much I can buy of some of these companies that I like. Usually we quit at 10% almost always. Now, if you told me I had a choice and I couldn't make a change, if you told me I had a choice of owning treasury bills, long-term treasuries, or common equities, I'd buy common equity, and I was going to keep it for 10 years or 20 years, I'd do it in a second. And we'll get the money employed. Something will happen.
Something will happen, meaning a big deal?
It could, yeah, sure. I could spend it all tomorrow. I mean, I wouldn't spend the whole 100, but although if $100 billion deal came along that Charlie and I really liked, we'd get it done.
You'd get it done by spending it all or by financing part of it?
Well, we'd probably have to, we might borrow 25 or 30, or we might sell some things. I mean, but one way or another, we'd get it done if we liked the deal.
There are questions that came in from shareholders that I got this weekend, and I didn't get a chance to ask you all the questions that came in. Some of them said, is $20 billion still the amount that you feel comfortable holding? Others asked, if you've got all this and you're telling all of us to put our money in an S&P index, why don't you put that $100 billion in an S&P index?
It wouldn't be the dumbest thing in the world if we did, but that's a lot to move in and out. No index fund would take it, I mean, to start with, knowing that we would might want to yank it out, 50 billion of it out in a week. So we'd almost have to create our own index fund to do it.
Well, it wouldn't be hard.
Well, it'd be a fair amount. I mean, they're better set up to do it than we are to buy 500 stocks in the proper proportions and keep it indexed. But we could create something that was a quasi-index fund, and that would have been smarter than what we've done, Becky. That was smarter. You know, I mean, I've thought about that some. I think it's a little harder to act when you see something later on if you do have to unwind 500 positions and all. I like to move when I move. So but net, if you told me over the next 30 years that Berkshire would keep its excess funds, so we'd still have 20 billion at least in treasuries, or treasury bills. But if you told me we were going to follow, for the excess money, we were going to follow an index fund policy versus a treasury bill policy, I would say the index fund policy would work well, assuming we could execute it reasonably well.
Okay. Let's talk about Apple, the place where you were spending the bulk of that cash that you were in the first quarter, where you were deploying it. $12 to $13 billion that you put in. That's on top of the, I think, $27 or $28 billion you already, maybe it was $29 billion you already owned in Apple as of the end of the year.
Yeah.
That's a big chunk of that $170 billion. It's the biggest stock that you own by far. It already was before you bought these additional shares, 75 million shares. Why?
Well, I should say, in the past, we had plenty of times when a single stock was a bigger proportion of our total net worth. But in terms of recent times, well, it was a company I liked, a business I liked very much, and we could buy a lot of it. There's some others that they're much smaller companies. We just can't buy that much. I might like them equally as well, but I can't put as much money in it. But I clearly like Apple, and we buy them the whole, and we bought about 5% of the company, and